The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Alistair McLeod, keeping you up to date with expert opinion on precious metals and the markets.
Hello, this is Alistair McLeod on behalf of Gold Money, and with me on the line from Vienna I have Ronald Stöferle, who was with Erste Bank, but has now set up his own fund called Incrementum, which is based in Liechtenstein. Welcome to the podcast, Ronnie.
Hi, Alistair. Thanks for having me again.
A change of career. This sounds quite exciting. I think it's a gold-based fund based in Liechtenstein. Have I got it right? Would you like to tell us a little bit about Incrementum?
Yeah, well, it's basically me and six partners. Most of them are from Switzerland. They were having great careers in private banking, wealth management, and we will be setting up a company in Liechtenstein. There's one physical gold and silver fund where I'll be the co-fund manager, and together with a friend of mine who used to be a fund manager in Vienna, I will start up a new fund based on the philosophy of the Austrian School of Economics, and basically we'll invest in gold, silver, and gold, silver equities, energy, and yeah, I mean, I shouldn't say too much because I think we should be another podcast as soon as the fund is already available. And I think it will be quite something new, and I'm really looking forward to the new challenges.
Well, that sounds very exciting. It sounds like there's quite a lot of experience, one way and another, backing this, which is good news. So it must be very exciting for you. Anyway, 2013 is ahead of us, so you have got the excitement of a new fund, and we've got the excitement, I think, all of us, of Europe, Japan, America, Britain. I mean, what a time to be launching a fund. I think if it was anything else other than gold and silver and energy, I think people would think you're mad. How do you see 2013?
Well, somebody said it's like opening an ice cream parlor in November, because the environment for within the financial industry isn't the best. But I replied, yeah, you just have to sell good ice cream, and I really hope that we're having good ice cream. No, I think 2013 will be quite challenging. I think all of the problems, all of the troubles that we were facing in the last few months and last few years, they are still here. They're even bigger than they were. We basically have just seen kicking the can further down the road. I think we'll soon be running out of the road. Therefore, I think it will be quite a volatile week. I think being allocated to gold and silver is still the right place to be. We're seeing negative real interest rates basically all over the world. The Fed said that they're going to keep zero interest rates at least until mid-2015. There are already rumors that there might be some sort of QE4 on the table. So I think that's a brilliant environment for being long gold and silver, as well as the equities. And yeah, as I've said, it will be challenging, but perhaps it's a bit like, we Austrians are crazy about skiing, and there's the old saying in Austria, when the weather is fine and when the snow is fine, everybody is a great skier. But when it's icy, when it's foggy, when the snow is bad, then you really can tell the difference between a good skier and a bad skier. And I think in this kind of turbulent times, there's really the market differentiates between good skiers and bad skiers.
Yeah, I think that's quite a good analogy, I must say. You mentioned QE4. I was very interested in that because My charts show me that they need to create money at an even faster rate than they're doing at the moment in America in order to stop, if you like, some sort of credit crunch arising for the second time perhaps. This QE4 timing seems to be quite coincidental. And on top of that, I get the feeling that there's quite a lot of nervousness in the banking sector, just sort of hints of this and that. How do you feel about that?
I think the whole discussion about the fiscal cliff is some sort of a scaremongering. I mean, we remember the Y2K bug and all the confusion around it, and at the end nothing happened. So I think they will introduce some sort of last minute deal. I'm absolutely certain about that. But when it comes to QE, I think that, which is basically in line with the Austrian School of Economics, the marginal utility of increasing debt is getting reduced at a very fast rate at the moment. So you basically need more and more units of new money, of new debt to see any effect. And I think, for example, for QE3, the sheer magnitude and size and I mean it's basically unlimited. I think nobody would have expected something like that 2 or 3 years ago. Therefore, I think we will see QE packages, we'll see rescue packages in sizes that nobody could really imagine at the moment. I think central bankers and politicians are basically running out of options, and therefore they will introduce packages that nobody would ever have believed that this might happen.
Yeah, it's getting bigger and bigger, isn't it? Turning our attention to Europe, I saw you recently in Vienna, which was a great pleasure for me, and we were talking about Germany's role in the Eurozone and what a difficult position they have now got themselves into. Have you any further thoughts on that, Ronnie?
Well, we're having elections not only in Austria, and I think the whole world is really looking at the Austrian elections in 2013. No, just a stupid joke. But we're having the big elections in Germany next year. Therefore, I think they will basically continue to muddle through. I think Angela Merkel will be going out of the elections as the winner again. And afterwards, perhaps there's gonna be some real decisions to be taken by Merkel. But for the next year until fall, I wouldn't expect too much. And basically, the Germans are in a kind of a lose-lose situation. No, I mean, everybody will blame the Germans if they let the Eurozone down. I think that the big question mark in the next year will be France, and I think with the latest decisions by President Hollande, I think France will be in really big trouble starting next year.
Yes, I think that's understandable. The automobile industry there has taken a very steep dive down, and I think Peugeot had to be bailed out not so long ago. I think also the attack on Mittal, the steel manufacturers, is indicative of the strains that the government there are facing. I think the political strains and the economic strains. France, the interest rates on the 10-year bond seem to be exceptionally low for such a risky investment. Do you expect those yields to rise soon, or how do you see that playing out? Or is the ECB perhaps intervening in it behind the scenes and keeping these yields down below where they would otherwise be? How do you see the yield situation for France?
I totally agree. Yields would have to be much higher for France. You mentioned the ECB, and I think Jim Grant said that central banks kind of changed from central banking to central planning, and therefore the size and the effects of their interventions are just horrible. And I'm absolutely certain that this will continue. I think coming back to the ECB, I think that the pressure on the ECB central bankers is really big. We've seen some of the last hawks stepping down recently, mostly the Germans. So the euro is really far away from being a hard currency, as the dollar is, as the Swiss franc unfortunately now is. So therefore, I think gold continues to be a soft metal, but by far the hardest currency. And I think when I started writing my first gold report in 2006, nobody really regarded gold as money, as an alternative currency. And watching the news and reading the news nowadays, you can tell that the market and people in general are regarding gold again as what it's always has been, the ultimate currency. And I think this will continue. That's why I'm writing that the remonetization of gold only just started. I think this will increase, and therefore I'm still extremely confident when it comes to gold.
Yeah, I think that's interesting, because we've moved from German representatives on the ECB either leaving or being so outnumbered that they've got no say. The euro, therefore, being inherently a weak currency without the controls, if you like, of the conservative heads, and therefore an increased, if you like, desirability when it comes to gold. One would have thought that there would be quite a lot of interest in gold in the Eurozone. You would think that quite a lot of people, rather than just moving money from Italian or Spanish banks to German banks, would be looking to move at least some of that money into gold. Presumably this is one of the things in the timing of you setting up Incrementum. But I just wonder, in a more general sense, do you see much interest developing in the Eurozone in gold itself as an alternative to the euro?
Absolutely. I think I think in 2007 I wrote about the portfolio characteristics and why it just makes sense to hold gold in your portfolio, like percentages between 5 to 10%, which isn't too much. And it just makes sense because, volatility is by far lower than for equities and commodities. There's almost no correlation to bonds. There's a negative correlation to equities on a long-term horizon. Therefore, it just makes sense from some sort of insurance perspective to hold gold. I think this is what the market and market players are realizing at the moment, but it just takes time, and we shouldn't forget that this 20-year bear market from 1980 to 2000 is still some sort of stuck in the heads of many market participants, and realizing that gold is around for many hundreds and thousands of years, that it never became worthless, that it's some sort of a AAA, that there's no liabilities attached. That just takes time. For us, we're basically reading quite a lot of about gold, about history, about monetary history, about the Austrian School of Economics. But people who are just how should I say, more on the mainstream side, for them it just takes time to realize that gold makes sense in this environment. I think what we're seeing at the moment, central banks from emerging market nations constantly increasing their share of gold. That's a big trend. Central banks will be net buyers again in 2012 and probably in 2013. So I think we're seeing a gradual shift of wealth from the west to the east, where the growth and prosperity at the moment really happens. Also for physical demand, jewelry demand, we're seeing China and India as by far the most important players. Emerging markets in general are responsible for 70% of physical demand. So demand from Europe and USA is not really important for the for the pricing of physical gold. And I think we're seeing, which is kind of slowly happening, that institutional players are stepping up their gold holdings, which are basically at zero. There's just a really nice chart by I think Shane McGuire, who shows that for the typical US pension funds, the gold allocation, gold and gold mining equities at the moment is 0.15%, so almost nothing. If they just double or triple their percentage, that would already have a big effect. And I think a point that we discussed recently is that gold will become some sort of a tier one asset again. And this is what I called in my last report the renaissance of gold in classic finance industry. And I think that's a really big trend. This trend will pick up momentum, and that's also a sign of this bull market.
That's interesting. I must say I hadn't realized that the portfolio ownership of institutions in America was as low as 0.15%. But on reflection, it doesn't really surprise me because, as you said, mainstream thinking doesn't actually include gold in any sort of portfolio or anything. And we did have a 20-year bear market, as you point out, and even though prices are considerably higher than they were in the previous bull market, I find that the level of interest in the establishment, if I can call it that, is still very, very low. Can we just very briefly turn to silver? Now, I think I'm right in saying that within Europe and therefore the Eurozone, silver is seen as less attractive because physical silver attracts VAT. Have you any comments on silver in the context of investors in the Eurozone? I mean, obviously they don't have to buy silver and store it at home. They can buy it through companies such as Gold Money and store it with them, or they can store it, or they can buy ETFs or something. But would you like to give us your thoughts on silver demand coming out of Europe?
Well, it's gradually rising, and I think. As everybody knows, industrial demand is still by far the most important driver when it comes to silver. But investment demand is just rising from year to year. And I think there will be a moment in time when people will say, okay, for me, buying gold is just too expensive, so I'll buy the little brother of gold, which is silver. And as you know, silver outperforms gold in inflationary times, and in deflationary times, you should be overweight gold compared to silver. But I think when it comes to the economy in general, I think the view for the next year is already extremely pessimistic. So I think there might be some room for upside surprises. I think the latest numbers, especially coming out of China, coming out of South America, they're some sort of encouraging. So I'm not that negative on the economy going forward. Therefore, this would be a good sign for silver. We're seeing some relative strength lately for the price of silver. I think within this bull market, silver will continue to outperform gold. So I can remember, I can imagine silver being above 100 without any problem. And you mentioned the VAT in Europe. There were discussions in Germany to increase the VAT to 19%. At the moment, it's I think 7%, but they postponed it to 2014. But that will definitely be a factor in Germany. People will buy more physical silver before 2014, before they will increase the VAT. In Austria, for example, the VAT is already at 20%. But people are buying silver nevertheless. And you probably know the old saying, gold is the money of kings, silver is the money of gentlemen, and what was it? Barter is the money of peasants. And debt is the money of slaves. And I think in this environment, you rather want to be a king or a gentleman. And I think there are a lot of slaves around at the moment.
Yes, I think that's right. Slaves perhaps to tax and things like that, as well as debt, unfortunately, which seems to be getting worse. I think if I can sort of briefly summarize your thoughts, and I hope I've got this right, I think what you have described is a situation where we're likely to have quite a shortage of gold and silver developing in the markets in 2013. You mentioned, for example, in the Basel, or you just touched on the Basel III changes when it comes to bank assets for gold. There's the continuing demand from the lesser developed nations, or rather the emerging nations, which have very, very strong savings flows, and you have got very low portfolio exposure in the West generally, and increasing systemic risk. Now, all this seems to me to add up to a potential for substantial shortages of physical next year. Would I be right in drawing that conclusion from what you have said in this podcast?
Yeah, absolutely. But I think for gold, for example, I mean, the stock to flow ratio is by far the most important factor when it comes to understanding gold. And therefore, I think there will never be a real shortage of gold. I think prices will just clear it. What I could imagine is that there's going to be, as you know, the paper gold market is way bigger than the physical market. And as you know, there are often rumors about the paper market being like 150 times bigger than the physical market. And if many market participants request physical delivery, that might
that's going to be difficult. Yes.
That might be really difficult. And you know, as soon as we're seeing for a longer time backwardation in the price of gold, I think that's a really good sign that this collapse of the paper gold market might happen. So I think from my point of view, if you want to hold gold, you should hold it physically. If you want some leverage on the price of gold, buy gold mining equities. I mean, you can buy large caps, mid caps, or even juniors. But I think you really have to differentiate between mining equities being an investment and physical gold being cash, like cash of the best quality. But I think at the moment both are really attractive. And if you expect some sort of collapse or financial Armageddon, you just have to hold physical gold, and you shouldn't go for paper gold like certificates or ETFs and that kind of stuff.
Well, that's rather what we believe as well. So, well, Ronnie, thank you very much indeed for taking part in this podcast, and we shall watch the progress of Incrementum.
Thank you.
With great interest, and we wish you every success with this new venture.
Thank you very much, Alistair. And yeah, a Merry Christmas and a happy, healthy and golden new year.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.